This is its financial history too, where money's past reveals tomorrow's truth. What if financial crises aren't accidents? What if they aren't failures of regulation, or unfortunate side effects of human greed, or unpredictable black swan events? What if every time an economy collapses, currencies devalue, or millions lose jobs, the same institutions quietly emerge wealthier than before? Here's the unsettling mystery. Across centuries, across continents, across wildly different political systems, financial crises seem to follow the same pattern: different names, different excuses, different victims, but the winners never change. Today, we're going to uncover why financial crises dawn to destroy the system. They feed it. And why attempts to fix the problem often make it worse. Welcome to its financial history too. To understand modern crises, we need to go backward, not decades, but centuries. Long before stock markets and hedge funds, power revolved around credit. Kings needed money to fight wars. Empires needed loans to expand. Merchants needed capital to trade. But here was the problem. Rulers were unreliable borrowers. If a king lost a war, lenders didn't get paid. So financiers developed a powerful solution: institutional distance. Instead of lending directly to rulers, money flowed through banks, bonds, and eventually centralized financial institutions that could outlive any single government. This separation did something profound. Governments absorbed political risk. Banks absorbed interest, and citizens absorbed consequences. This structure didn't just survive, it evolved. By the 19th and 20th centuries, national banking systems, central banks, and global lenders had emerged. They didn't just supply money, they defined stability itself. And once you define stability, you can profit from instability. The earliest financial crises revealed a repeating mechanism. Step 1. Easy credit. Banks expand lending during good times. Asset prices rise, confidence grows. Step 2. Overexposure debt accumulates faster than real economic growth. Speculation replaces productivity. Step 3. Shock: a war, commodity shortage, policy change, or market panic triggers collapse. Here's the key part most people miss. When collapse happens, assets don't disappear. They transfer ownership. Land, companies, infrastructure, housing, all still exist. But now they're cheaper. And only institutions with liquidity can buy them. Crises don't destroy wealth. They reassign it. By the 20th century, financial institutions learned to do something revolutionary. They learned how to socialize losses and privatize gains. Banks lent aggressively during booms, earning fees, interest, and bonuses. When busts came, losses threatened the entire economy. And that's when a powerful argument appeared. If we fail, everything fails. This idea, too big to fail, changed everything. Governments began acting as backstops. Central banks injected liquidity. Bailouts stabilized markets. But notice the asymmetry. Profits remained private, losses became public debt. And citizens paid through inflation, austerity, and reduced services. Crises stopped being existential threats to finance. They became manageable events. Every system eventually stretches too far. In major crises, whether the Great Depression, the Asian financial crisis, or the global crash of 2008, the same moment arrives. Confidence collapses. Credit freezes. Markets panic. Ordinary people experience the crisis immediately. Jobs vanish, savings evaporate. Homes are lost. Institutions experience something very different. Emergency lending facilities open, interest rates drop, asset purchases begin. While the public hears the word recovery, institutions hear something else. Discount. This is where fortunes are made. After the crash, the narrative always focuses on recovery. But recovery for whom? Historically, after major crises, large banks become larger through consolidation, market competition shrinks. Political influence of finance increases, wealth concentration accelerates. Why? Because crises eliminate smaller players. They wipe out individuals and local businesses. But large institutions gain market share, government guarantees, and favorable regulations. The system doesn't reset, it hardens. Each crisis makes dominant institutions more central, more indispensable, and more powerful. After every crisis, reforms are promised. New rules, new oversight, new safeguards. But look closely at what reforms usually do. Increase compliance costs, hurting small firms. Strengthen centralized oversight, benefiting large players. legitimize emergency powers for future crises, regulation often becomes a barrier to entry, not a shield for citizens. The system claims to be fixed, but the incentives remain unchanged. Risk-taking still pays during booms. Protection still exists during busts, so the cycle continues. Today's financial world uses new terms: quantitative easing, liquidity injections, macroprudential policy. But the pattern is unchanged. When crises hit, central banks expand balance sheets, asset prices recover faster than wages, inequality widens, debt increases, markets rebound. People struggle. And once again, the same institutions emerge stronger, more interconnected with governments than ever before. The system has learned how to survive collapse. But survival isn't the same as fairness. The uncomfortable truth is this: the financial system isn't designed to prevent crises. It's designed to absorb them. Crises justify emergency authority, centralization of power, transfers of ownership, permanent policy shifts. From the system's perspective, crises are not failures. They are stress tests that justify expansion. Takeaway 1. Financial crises don't destroy wealth, they concentrate it. Takeaway 2. Institutions that define stability benefit most when stability collapses. Takeaway 3. Reforms that don't change incentives only strengthen the cycle. The question isn't whether another crisis will come. It asks whether the next one will transfer even more power or finally expose the structure beneath the chaos. Because the more often the same institutions survive every collapse, the less accidental those collapses begin to look. If this video challenged the way you see financial crises, take a moment to question the stories we're told during the next one. Like the video if you value deep, system-level explanations. Subscribe if you want more long-form breakdowns of hidden economic power. And leave a comment. Do you think crises are failures or features? Because understanding the pattern is the first step to breaking it.